The recent SEC investor alert on crypto asset securities has sent shockwaves through the cryptocurrency market, reminiscent of the cautionary steps taken before the approval of Bitcoin futures. This alert coincides with speculation surrounding a potential spot Bitcoin ETF following an update in BlackRock's application. The SEC, however, has thrown a curveball at BlackRock by requesting specific language amendments to their ETF filing. In the amended language, a crucial distinction is drawn between Bitcoin, considered not to be a security, and altcoins, which might face classification as securities in the future. This nuance in wording opens a Pandora's box of potential challenges for altcoins, ranging from trading hurdles to issues in clearing and custody, should they be determined or asserted to be securities. Interestingly, the SEC has highlighted 3 altcoins that are deemed to be SEC compliant, or at least on the path to regulatory clarity. The first among them is XRP, Ripple, which recently witnessed the dropping of the SEC versus Ripple lawsuit. This legal resolution provides a semblance of clarity, confirming that XRP is not considered a security. Furthermore, Ripple's CEO and executive chairman have been exonerated from baseless allegations, adding weight to XRP's status in the crypto landscape. Polkadot, DOT, is another altcoin in the spotlight, having undergone a meticulous 3-year process with the SEC to transition from security status to software. The collaboration with the SEC to ensure compliance with U.S. federal securities laws underscores the lengths to which projects are willing to go for regulatory approval. Chainlink, Link, has not yet received the SEC's green light, but it has made waves by announcing a partnership with Swift for cross-chain interoperability. While the partnership is seen as significant, the lack of SEC clearance introduces an element of uncertainty to Chainlink's future. The SEC's approach, as reflected in BlackRock's filing, signals a need for rigorous financial auditing for altcoins aspiring to gain ETF approval. Compliance with U.S. federal securities laws is emphasized as paramount for digital assets navigating the regulatory landscape. The involvement of Swift in Chainlink's endeavors is noted as a powerful connection to global regulators, potentially influencing the SEC's decision-making process. In the broader context, the investor alert underscores the critical importance of regulatory compliance in the crypto space. Even well-established cryptocurrencies like Ethereum are not immune to scrutiny, with a reminder that their non-security status is not 100% confirmed. The regulatory landscape is dynamic, and industry participants must navigate evolving standards and expectations. The mention of the SEC's first loss in a crypto case, particularly in the Ripple lawsuit, adds an intriguing layer to the unfolding narrative. This legal development could influence the SEC's future actions and attitudes towards other cryptocurrencies facing regulatory challenges. The industry is closely watching how this loss might impact regulatory enforcement and interpretations moving forward. Polkadot's journey from a security to software status serves as a case study in perseverance and cooperation with regulatory bodies. This deliberate effort to align with SEC requirements showcases a commitment to navigating the complex regulatory framework, setting a precedent for other projects seeking regulatory clarity. Chainlink's collaboration with Swift, while lacking SEC approval, highlights the intersection of traditional banking systems with blockchain technology. The partnership is positioned as a significant step towards blockchain integration in mainstream financial systems, potentially influencing the broader regulatory landscape. As the industry grapples with these developments, there is a looming concern about the potential challenges that altcoins may face in achieving SEC compliance. The SEC's focus on financial auditing and adherence to securities laws adds a layer of complexity for project. The recent surge in Bitcoin has left many scratching their heads, challenging conventional wisdom and defying expectations. Bitcoin, often deemed a volatile and unpredictable entity, has seen a notable uptick in its value, sparking debates and speculations across financial circles. This unexpected rally is attributed to several factors that merit close examination. One key driver behind the surge is the widespread anticipation of a Bitcoin exchange-traded fund, ETF. The mere possibility of such a financial instrument entering the market has sent ripples through the crypto community, with investors eagerly awaiting the potential influx of institutional funds. The prospect of legitimizing Bitcoin through a regulated investment vehicle is seen as a pivotal moment for the cryptocurrency. Another noteworthy element in Bitcoin's recent ascent is the steadfast conviction of its holders, often affectionately referred to as hodlers. Despite a staggering 150% increase in the past 12 months, a remarkable 70% of the circulating supply of Bitcoin remains securely clutched by these hodlers. This steadfast behavior has become a defining characteristic of the Bitcoin community, with many viewing it as a testament to the underlying strength and resilience of the digital currency. The dynamics of the market paint a fascinating picture of forward-looking behavior. Bitcoin, often considered a free market asset, appears to be subject to a reflexive feedback loop of hodling. This sustained commitment to holding onto the cryptocurrency may, in turn, be contributing to its continuous upward trajectory. It's a cycle where confidence in Bitcoin's future prospects feeds into its rising value, creating a self-perpetuating mechanism. Amidst these market dynamics, questions linger about external factors influencing Bitcoin's surge. Speculation abounds regarding the role of financial giants like BlackRock and the potential impact of macroeconomic conditions, including decisions made by Joe Biden's Federal Reserve. The interconnectedness of global financial forces adds an extra layer of complexity to understanding the driving forces behind Bitcoin's recent pump. In terms of ownership and mining distribution, a seismic shift occurred with China's crackdown on Bitcoin mining. Following the mining ban, the United States has emerged as a dominant player, hosting approximately 35% of Bitcoin's hash rate. This shift not only reshapes the geographical landscape of Bitcoin mining but also underscores the decentralized nature of the cryptocurrency. Determining ownership distribution is a trickier task, with capital flows providing some insights. The United States and Asia seem to be key players in terms of Bitcoin ownership, indicating a concentration of the digital asset in these regions. The interplay between ownership patterns and regional dynamics adds another layer to understanding Bitcoin's current position in the global financial landscape. Bitcoin price predictions, a perennial topic in the crypto space, continue to fuel debates. Michael Saylor, a vocal Bitcoin advocate, has put forth an optimistic view, suggesting that if Bitcoin were to match the market value of gold, its price could soar to an astronomical $500,000. Such predictions, while met with skepticism by some, add to the ongoing narrative of Bitcoin as a potentially transformative asset. The idea of Bitcoin as a store of value gains prominence, particularly in the context of concerns about central banks resorting to money printing to finance mounting debts. Bitcoin's finite supply, capped at 21 million coins, contrasts sharply with traditional fiat currencies subject to inflationary pressures. This narrative positions Bitcoin as a hedge against inflation and a store of value, akin to precious metals like gold. However, skepticism persists, especially from traditional finance perspectives. Critics often draw comparisons between Bitcoin and gold, questioning the former's intrinsic value and the basis for its valuation. Despite these doubts, proponents argue that Bitcoin's distributed ledger technology, the blockchain, distinguishes it as a unique form of money, challenging established norms and redefining the concept of value in the digital age. In this evolving landscape, Bitcoin's ascent challenges traditional worldviews held by the financial establishment. Concepts like intrinsic value and the efficient market hypothesis, long considered bedrocks of economic theory, face scrutiny in the face of Bitcoin's unconventional rise. The distributed ledger technology that underpins Bitcoin introduces a new paradigm, suggesting that if this alternative worldview proves accurate, trillions of dollars could find their way into the cryptocurrency. As Bitcoin disrupts established norms, the broader financial community grapples with a new reality. The philosophical underpinnings of Bitcoin's rise force a re-evaluation of what constitutes value in the digital age. It's not merely a speculative asset but a potential reimagining of the financial system, challenging long-held assumptions and paving the way for a decentralized and borderless form of value exchange. In conclusion, Bitcoin's recent surge defies easy explanation, drawing attention to a confluence of factors that contribute to its upward momentum. From the anticipation of a Bitcoin ETF to the unwavering commitment of hodlers, the market dynamics of this digital asset paint a complex and dynamic picture. As Bitcoin challenges traditional finance worldviews, it prompts a broader reflection on the nature of value, money, and the future of finance in an increasingly digital world. Disclaimer: the information is for general purposes. Viewers should conduct research and consult professionals for financial decisions. Please go ahead liking, subscribing, and sharing with friends to support our channel.